Good morning. Welcome to Friday's Trading Hour. I'm Reema Tendulkar, with me Surabhi Upadhyay, and the march higher on the Nifty continues. We've crossed 24,600 at the day's high. There is strength which has come through in metals, pharma. IT is also having a good day, but look at the mid-cap index. The mid-cap index has gained 1,000 points. It's a 1.7% rally today, taking its weekly gain to about 3.5% and a solid advanced decline ratio to back the up move on the index. Across the board gains, right?
Absolutely. Reema, I call it the invincible week because that's what this week has made us feel, right? 5 trading sessions, so much thrown at this market, including the budget, including a lot of mixed global cues. And look at what you have. I mean, of course, the Nifty with the move today is barely 1% away from the all-time high. That number comes in closer to 24,850 thereabouts. So we're practically there. And if you look at the week's tally, Reema was talking about mid-caps. They are the shining light in the market. The mid-cap index is up about 3.2%. The Nifty has managed to flatten out, despite, of course, the budget day volatility and so much more going on. Nifty is flat. It's the banks which are the sore spot for the market because the Nifty bank is down almost 5% for the week gone by. So banks is where the problem is. Now, why do I say invincible week? Because the market has dealt with 3 big blows and come out of it absolutely unscathed. One, higher taxation. Number 2 is a global sell-off. We've seen the kind of rotation in the US, big decline days this week for Wall Street. None of that has impacted us. And the third is patchy bank earnings because bank numbers have not exactly, made the street feel very confident. That's why the underperformance of the bank Nifty. But, none of this really matters because the market has simply moved on. By the way, I just wanted to add here, while we talk about very strong domestic liquidity, July has also seen the highest FPI inflow of the calendar year. The numbers are pretty staggering. I mean, over 35, almost 36,000 crores coming in via the FPI route. Now, some of this could be the secondary sales, all the block trades that you see. Maybe not necessarily all the, the direct buying that you, see in the market. So that's how it is. Market's been extremely strong. Later this evening, we will have the US, PCE numbers, but given the way the market has moved, actually, I mean, it almost seems, Reema, that global cues don't matter anymore. We are dancing to our own beat, and that beat is really being fueled by a lot of domestic money.
Oh, indeed. But let's, not to forget, we've got a lot of corporates as well to talk about. Sorry. So the first up, it's Praj Industries. They've reported a mixed set of Q1 numbers. The order inflow has slowed down for the 4th consecutive quarter, but margins are at a multi-quarter high despite the dip in revenue. Shishir Joshipura, MD and CEO of the company, is now with us to take a few questions. Thank you very much for joining in. The revenue in FY24 degrew by 2%. In Q1 too, we've seen a drop in your revenues. What's the outlook for FY25? And are you on track for your 2030 target?
Yes, we have seen some moderation of our revenue in the recent quarters, but we are very, very confident that our target, that guidance we gave for 3x in 2030 stays. In fact, what's happening is that our business is transiting in terms of its over-dependence on one particular segment to multiple segments across, and that is what is now reflective. So that transition is taking a little bit of a time out of sync, if I can use that word. Overall, we believe that we are very much on the track to achieve the guideline that we gave.
Okay, sir, what's driving the improvement in margins despite the dip in revenue? Is this the level of margins that you think is sustainable, or do you think you can actually improve on it?
So the way we are looking at our margin development is a function of multiple dimensions. Our product mix is changing, our geography mix is changing, and it's changing favorably in terms of our ability to report better margins. The commodity prices have started to moderate, so that's another helpful factor. We believe that as the trend continues, we will be in a position to continue to have a better bottom line result reported. However, whether it will become higher than this or will become lower than this is a matter of time. So I would not be able to give a specific number around that. What's very important to see is that our business mix is changing in favor of improved margin businesses.
Okay. What about the order inflow? Your order inflow is a decline for the 4th consecutive quarter. Is this a conscious call, or are we seeing a slowdown in ordering activity? And do you have a target for FY25?
So yes, we have seen that our till about 4 quarters ago, our biggest segment used to be the domestic ethanol business. And there, because of the two, what I would call as temporary measures that were introduced on the feedstock side by the government, one on the rice stoppage of rice issue from FCI go downs, and the second one on the sugary feedstocks when syrup and molasses B were temporarily taken out from the permitted feedstock list. These two led to a slowdown in our largest segment. We were working on other segments in any case on a parallel basis, and that is what has helped us to actually keep the trajectory of our order booking where it is. And we believe that the work that we have done and the inquiry pipeline that is built up for us, especially in the energy transition space, is actually going to start changing the direction very, very soon.
Okay, you're targeting apparently 50% revenue mix from exports by 2030. Right now, you're at 19%. Just talk us through the demand environment. I mean, are you confident that you'll be achieving these targets, and which are the geographies that are doing well for you?
Yes, we have given a guidance that we would like to shift from a 19% base to a 50-50 ratio as we move through 2030. And the quarter that has gone by, we have seen our order book at the 42% of the order coming from the export business. And that's been the trend over the last 4 or 5 quarters that we have seen the export percentage of the overall pie increasing from 19 down to 42%. What we are seeing is clearly the energy transition space and the low carbon ethanol. These are two spaces where we are seeing increased activity, and that is supported by the fact that as we move forward, we'll also see sustainable aviation fuel start to play a major role out there. So these three factors combined are actually leading to a situation for us that our export markets are beginning to grow at a very, very fast pace. Although in the export markets, the business cycles and the models are different, so compared to India, so timelines are a little extended. However, when they happen on a very certain kind of a time framework. So we are very, very confident that as we move forward, we will see this dynamics change that is taking place play out favorably for the company.
Okay, let's move on. You had engaged with 8 clients for energy transmission and climate action. When do you expect these engagements to bear fruit?
So if you would actually see, we have seen these already started to. So energy transition and climate action is the segment that we have spoken about. And we had mentioned about a very significant contract that we got from a blue hydrogen utility in the last quarter. And in the quarter just gone by as well, we have received a contract for managing carbon sequestration system for a blue hydrogen project again in Europe. So Europe and America are likely to play out a very major role for the ETCA segment of ours. And we clearly see a lot of activity build up there taking place, especially on the blue hydrogen, green hydrogen, and waste to energy projects.
You've commissioned the Mangalore facility. As inquiries get converted into orders, how quickly do you expect this to ramp up, and what's the revenue potential?
So the Mangalore facility is now ready to start producing. We have already taken out the first prototype production out of the facility so that we have tested our systems and processes and people and flow, etc. So now we are going fully ready for the commercial production. And as we move through the year, we'll start to see the shop starting to produce. Of course, it will not be able to deliver at its full capacity in the year. But when fully commissioned and fully loaded, it will actually be able to add close to 2,500 crores to our top line.
Got that. And a quick word on the margin profile of these orders.
The ETCA segment is essentially centered outside India, and most of the contract, this is also inside a special economic zone that we have this plant located. Therefore, we expect that most of the orders will be for supplying outside India, and the margin profile for export orders is significantly different than and better than the domestic business.
You were awaiting approval from the government on the JV with IOCL. What is the update there?
Yes. So the good news is that the formal approval from the government authorities is now available to us. It actually happened last week. as we speak. So we are now going through the process of the board approvals from both the and parent entities. And as soon as that is there, we'll make a formal announcement.
Okay, thank you very much, sir, for joining in. Need to get into a very short break. We'll come back and discuss commodities. Manisha Gupta joins in on the other side.
Welcome back. Let's shift the focus to the commodity space now. We have Manisha Gupta joining in, and I believe she's looking at crude today. Manisha, what's happening in the crude markets?
Well, thank you for that, Surbi. We've seen the prices recover slightly in the day today. We saw nearly 0.5% off again in the overnight markets as well. But even with that, we are still trading at around 6-week lows. And this is going to be a third straight week that we're looking at the crude oil prices on a declining spree. For the month of July, we've seen crude prices decline by 4%. Well, if you look at the second quarter GDP numbers for US, that came in on the stronger side at 2.8% versus street expectation of 2%. That is what really seems to be supportive in case of crude. And then apart from that, the US inventories also have seen a decline for a fourth straight week. 3.7 million of decline in inventory for crude, and the gasoline inventories have declined by 5.6 million barrels. So that tells you that on ground physical demand seems to be picking up. And then it also has been about the wildfires in Canada, especially in British Columbia and Alberta, which is very close to the oil pipeline facilities, and that has taken the sentiment on the higher side. But then apart from that, and that's exactly where the good news ends, because when you look at the data that has come in from China in sense of crude imports has been on the weaker side. The manufacturing data from US, Japan, Germany, all has been on the weaker side. And then the street is also looking at various conversations between Israel and Gaza, where there is ceasefire conversation that really seems to be progressing well. So that premium seems to be getting off the prices. The street does believe that it really is going to be between 78 to 84 of a range that you could perhaps see in the crude oil prices for the month of August as well.
Okay, thank you very much for that. We will slip into a very short break. We'll come back and talk about what's hurting the banking stocks today. Stay tuned. Welcome back. It's now 250-point gain on the Nifty, and the Nifty bank has moved up in the last 30 minutes. It's 50,900 from the day's low. It's a 470-point recovery on the Nifty bank. There you have it. From 11 o'clock, there has been a surge in the banking stocks, particularly a Kotak Mahindra Bank. But the news that's come from the RBI is negative for banks. They've increased the liquidity coverage ratio. These are draft rules right now, but how do they impact? Lata joins in with an explainer. Lata.
Well, yes, the Reserve Bank has said that banks have to keep more liquid cash. Okay, first let us understand what liquidity coverage ratio means. See, banks will always get demand from people who are withdrawing deposits. So the liquidity coverage rule is banks have to make an assessment that over the next 30 days, how much money will be withdrawn. That money has to be kept in easily liquefiable instruments like government bonds. That ratio is called the liquidity coverage ratio. Now, what has happened is because of internet banking, mobile banking, this number has become a very different number because you can instantly withdraw money. You know, you're paying everything through either a phone pay or a GPay or a Paytm, and therefore the amount of easily available savings deposits, that amount is declining. And that is what this liquidity cover increase is addressing. What the Reserve Bank says is that banks have something they call stable deposits, people who don't withdraw too often. There, they used to keep 5% of that as liquid cash. Now they have to keep 10%. And in others, fast-moving deposits, what they call less stable deposits, they had to keep originally 10% of those deposits in the form of easily liquefiable instruments, that's government bonds. Now that has been increased from 10 to 15%. Okay, the term deposits are the ones that banks like very much because they are, you know, for a long time and you don't have to keep liquidity in front of them. But what RBI says is if those term deposits are lent as collateral for borrowing, and many companies do that, then again that will be treated as a retail deposit. So you have to keep liquidity cover of 10 or 15% depending on which category they fall. These are the three things that are increasing the liquidity that banks have to keep. as liquid cash. And the fourth thing is that the valuation of the bonds, how do you keep liquid cash? You keep government bonds, right? Now, the valuation of those bonds used to be the printed price, etc. Now they're saying it has to be the current price at which they will be valued. All this means that banks have to put a little more money in government bonds, and it's not little. For the sector as a whole, one banker gave me a calculation, about 5 lakh to 6 lakh crore more will have to be put into government bonds. Of course, this becomes effective in the next fiscal only. So there is time, and banks will be able to give feedback. But if you put more money in bonds, what happens? The sovereign pays the least. If you had put the same money in a credit card loan, you would have made so much more money. So where is the first hit? The first hit is on the margins. The second hit is then everybody will now go for longer term deposits with a greater ferocity. So deposit costs increase. That also impacts margins. These are the problems where it is going to hit. But I want to leave you with 2 or 3 important things. There is no need for banks to sell off today. It is only draft. The feedback will come, and it becomes applicable in the next, after many months, after 7-8 months. So many things can change for banks. So going short on banks today doesn't make any sense. All banks also have much more liquidity cover than 100%. If your requirement is that you have to keep 100 rupees in bonds, many banks keep 130 rupees in bonds. Some of the PSU banks keep even 140. Now, banks will just reduce that. Let us keep only 108, 109, a little more than the buffer. They will reduce the buffer. So it need not necessarily mean that the margins are going to come down. We don't have to run away with these fears, but there is no taking away from the fact that more money is going into government bonds. So in this whole thing, who is the winner? Government.
Okay.
Bonds, more demand for their bonds.
Got that. Lata, thank you for explaining. I think banks are being shorted, or people are selling banks for a lot of other reasons, right? The whole environment, right from the increase in risk weights, crackdown on unsecured, and the whole mobilization
if you saw
of deposits.
the results of, first HDFC Bank, then Bajaj Finance, then Axis Bank, Federal Bank, not Federal Bank so much because they have NR, non-resident deposits. The Keralites who live in Dubai, so they are not that hit. Yeah. The others have all been hit. What you realize is that deposits are hard to come by. There is a fight.
I don't know if you guys have experienced this or not. In the last week, 3 banks have called me up saying, can you please park more deposits? We're offering as much as 8%.
No, yesterday HDFC Bank raised it by some 30 basis points or something.
And the RMs are really working their phones that, madam, do you want to book a deposit? It really tells you about the kind of times that we are in. Well, Lata, thank you very much for explaining that to us. We did catch up with Rikin Shah, Vice President at IIFL Securities, to get a perspective on this, as well as Mr. Satyanarayan Raju, MD and CEO at Canara Bank, to understand what the impact could be on overall banks and, of course, on Canara in particular. Take a look.
They have been consuming excess liquidity, and they have brought down LCR very dramatically by 15 to 20 percentage point in last 2 years. They are still higher than your private banks. Currently, private banks are around 120%, PSU banks are around 130-35%. That is how things stand today. Among the top 15 banks in India, IndusInd, IDFC First Bank and Federal Bank have relatively lower LCR compared to the peers, of course, much above the regulatory minimum of 100%. We estimate that the LCR, pro forma LCR, can go down by anywhere from 10 to 20 percentage point and drive margin compression and earnings impact for the bank. So it's an incremental negative for the banking sector.
Our liquidity is for existing. We are very much comfortable. We are at the range of 135 to 140. That's the existing liquidity what we are maintaining it. What the guidelines yesterday our regulator has issued, we have assessed roughly in the morning, and it is impacting 10 to 11 basis points. I don't think that will have a problem for the Canara Bank, because even after doing all these things also we will be more than 120-125%. So I don't think it impacts our credit growth or CD ratio or anything.
Okay, we'll get into a break. On the other side, we'll invite the management of PNB Housing Finance to talk about their Q1 numbers.
Welcome back. You're with us on Trading Hour. We have the management of PNB Housing with us. Of course, Housing Finance Major reported Q1 numbers. The company has beaten estimates and saw its net interest income rise 2.8% sequentially. Profit after tax was up about 26% on a year-on-year basis. We have with us Mr. Girish Kausgi, MD and CEO of PNB Housing Finance. Sir, thanks for joining in. Let's start first by understanding business growth and the prospects this year. As I look at the first quarter, your AUM is up about 7.5–8% year-on-year, about 2% quarter-on-quarter. But disbursements were down sequentially, Q4 versus Q1. Just tell us what is your own target. What will be the AUM growth in this financial year? And also add to it the fact that we've heard all of these new budget announcements, right? There's talk of fresh impetus to housing and maybe, some kind of a further interest subvention as well. So what clarity do you have on those announcements, if any, and your overall target in terms of growth this year?
Good morning. I think if you look at the whole year, quarter one seems to be slightly muted compared to other quarters. And therefore, the comparison would be on YOY, not sequential, because quarter four is always the best quarter for any company on the financial side, especially into housing. So if you look at on a YOY, disbursement, we have grown by 19%. Book growth is 14.4%. If you look at the same book growth number last year, quarter one, it was 11.5%. So last year we closed book growth at 14.1%. So this year we are guiding on the retail side, book growth of 17%. So we are on track. Disbursement grew by 18%, PAT growth of 25%, margins are stable. So I think we had a very good quarter because I think most of the company in this quarter would show muted growth. So for us, there was growth in disbursement, growth in book, margins stable. GNPA came down from 1.5 to 1.35%, and corporate GNPA is now 0.
I know asset quality performance is very good, sir. Yeah, just to, because you gave us a lot of numbers. Once again, I'm just to reiterate, FY25 AUM growth target is how much?
Book growth will be 17% growth on retail.
17%. Okay, you were talking about the budget announcements.
Yeah, so no, we have a very high level disclosure, in the budget. I think the schemes are yet to come, but based on the conversation, what we've been having in last 2 months with various authorities, the scheme is going to be big. It's going to be really, really big, PMAY, which means the allocation is going to be higher, which is going to help the lending institution on 3 counts. One, the cost of borrowing will come down because this PMAY funding will come at a lower cost to the lending institution. It would also lead to better margins compared to what it used to be in the earlier 2 terms. So the margins are going to be better. It will improve margin profile. And third, it will definitely increase growth. So there is a lot of growth opportunity, not just on the affordable or the emerging, which is basically focused on urban and semi-urban, but even for us, all the 3 segments, prime, emerging, and affordable, all the 303 branches are geared up to make use of this opportunity.
Your net interest margins at 3.65% is ahead of your long-term 3-year guidance of 3.5%, which you had laid out when you did that investor meet a couple of months back. Can you maintain your net interest margins, and has your cost of funds come down? Because you'd spoken about how the recent upgrades by credit agencies will help bring down your overall cost. So if you could give us those 2 numbers.
So if you look at the cost of borrowing sequentially, it has come down by 6 bips. It was 7.98. For quarter one, it is 7.92. Incremental cost of borrowing has come down to 7.75%. So we were able to bring down cost, and this would pan out in next couple of quarters. We'll be able to further bring it down by a few bips. That's number one. Number two, with this additional funding coming in through allocation via PMAY, will also bring down the cost. In terms of margins, yes, our threshold is 3.5%. If you look at last couple of quarters, it is 3.65. We'll be able to maintain this margin level for next few quarters, and then it will start inching up.
Okay. Also on AUMs, your target was hitting 1 trillion by FY27 hence. That's FY27 end. That's 3 years from now. Where do you think you will end FY25 with in terms of AUM? Because year on year, your AUM growth has been less than 8%.
So I think we should talk about the loan book. So if you look at the loan book as of June, overall book is 67,000 crores. Out of that, retail is significant. Retail is 65,160 crores. So if we see this year, the retail book will grow by 17%. and largely the growth is going to happen in the retail side. We plan to start corporate in H2, so we will be able to add maybe close to 1,000 crores this year on the corporate side. As of now, the corporate book is little over 1,800 crores, so we'll be able to add about 1,000 crores in the corporate side. On retail, we'll be able to show growth of 17%. And within retail, our focus is going to be on affordable. Affordable, as of June, our book is 2,330 crores. We'll be able to take that book to 5,000 crores, followed by emerging and then prime. So the overall is 17%. If you look at the growth in affordable, it's going to be about 170, 180% growth on book. If you look at emerging, it'll be about 19. Yeah.
Okay, just a quick number. What was the credit cost this time, and what can you guide for the full year? Has it gone up?
We have guided credit cost this year 30 bips. I think for quarter one it was negative, so -7 bips. So we'll be able to maintain credit cost.
Okay. All right, Mr. Kowski, we'll leave it on that note for today. Thank you very much for giving us an update on the business, and good luck for the rest of the year as well. Well, we haven't had a look at the market in a while, and the market continues to surge along 1% higher on the Nifty. By the way, today's listing is also doing really well. Sandstar into a lot of products that are made out of maize, and they go into all kinds of industries, including foods and so much more. 30% up. That's a listing that's done really well. A lot of stocks actually up and about. Ashok Leyland, Memphasis, Home First Finance. By the way, we're talking about PNB Housing. Home First Finance's numbers have also been very well received by the market. So lots of excitement there on that stock, about 6% higher. That's the market. We do need to take a very quick break on that note. We'll come back on the other side and get you key excerpts from our exclusive conversation with Shantanu Roy, Chairman and MD of BEML.
Welcome back. Now, the Indian government has set aside 6.2 lakh crore rupees for defense spending in the union budget. Now, this is up from 5.9 lakh crore in the prior budget. The capital outlay has been pegged at 1.72 lakh crore rupees, and the total allocation for the defense sector is now 12.9% of the overall budget. Parikshit caught up with the BEML chairman and MD Shantanu Roy to understand the potential of the Indian defense sector going forward, and he started the conversation by asking about the company's growth guidance for the current year. Listen in.
Growth guidance that I can see should be around 20% for FY25, and this should be the trend for the coming few years.
Right. In terms of the quantum of orders that you're expecting by the end of this fiscal, how do you expect the order book to grow?
Our current order book position is around 11,800 crores, and we expect at least 30,000 crores, maybe 25 to 30,000 crores of orders, maybe another during the current financial year, and I expect that we will end up somewhere between 20,000 to 30,000 crores of order book by the end of the financial year, that is on 31st March 2025. And the major impetus will come from the rail and metro sector, where we are expecting some good orders, some tenders I expect will be finalized by the time. Some tenders in the commuter rail which were pushed back from last year, if those are also finalized during the current financial year, then definitely it will be a very good run for a company like BEML.
Right. When you speak about railways, the Vande Bharat program is one of the big ones. What is the kind of orders that you're expecting on Vande Bharat trains? How many Vande Bharat trains are you set to deliver in the near term?
The order that we have for Vande Bharat is for 10 rakes or 10 trains. And the first Vande Bharat train, it is nearing completion, maybe 10 days down the line, we should be in a position to roll out the first Vande Bharat sleeper. As far as the future Vande Bharat trains are concerned, we have to look at the number of trains that the government wants, more than 500, 600 Vande Bharat trains in the coming 4 to 5 years. And if we talk about 2047, then that number grows up in a huge manner. So the positive point for us is that we will have the first mover advantage. by delivering the first Vande Bharat sleeper train for the country, which also makes us ready for undertaking any export projects in the future, which the government may be envisaging, or which may be coming from the foreign countries who will be willing to take our trains. It may be Vande Bharat broad gauge or Vande Bharat sleeper standard gauge.
By the end of FY25, would you be able to deliver up to 10 Vande Bharat trains?
Yeah, definitely.
Okay, get into a break. We'll come back and discuss market fundamentals. Jyotivardhan Jaipuria from Valentis Advisors joins in next.
Welcome back. You are with us on Trading Hour. Well, we have Jyotivardhan Jaipuria from Valentis Advisors joining in to talk about the market and the way ahead. Jyoti, it's been a big week for the market, and one thing that comes out clear is that this market will rise come what may. You know, you've got a tax increase, not multiple tax increases actually. You've got global markets which are selling off, but yet we keep rising. What do you make of things? Does it worry you, or is it just best to ride with the tide and leave the worries aside?
Yeah, so we are riding with the tide, Survi, but yeah, it does worry us in the sense that valuations are not cheap now. So whatever margin of safety was there some time back has disappeared. So, you know, it will be best if the market gets into a bit of consolidation. So we correct valuation, move through time correction. Otherwise, at some point, if we get a steeper price correction, then that could be like a little unnerving. So I think it's a market where you have to pick your pockets. Valuations are not cheap. Growth is still coming. So that's the one positive, that so far there's no signs of growth really slowing down. Though if you look back at the earnings season so far, it's been a tad disappointing rather than a tad positive. And of course, a lot of regulatory changes which are happening, most of them are actually negative for the market.
Okay. You're saying the earnings has been a bit disappointing. Do you think the overall earnings growth is at risk for FY25, which could cap or limit the upside? And also, is there any change in the way you would construct your portfolio? Because even leaders in the market do run their course and you need to rebalance.
Yeah, Rima. So, you know, we were going in for FY25. We are looking at quite modest 11-12% sort of growth. So my view is next 2 years growth you have to think of growth more in line with the nominal GDP growth rather than, 4-5 basis points higher than the nominal GDP growth which we've seen in the last few years. So I think to that extent, our numbers may be okay. There are a bit of optimism among some analysts who are looking at 15-17% growth, which I think will get toned down as we move into the year. So when we do our valuations and when we do our market forecast, we are looking at earnings growth next 2 years of roughly 11-12%. So from our point of view, probably like if we get the market flattish for next 8-9 months, then that may be good. In terms of portfolio construction, what we have been doing is largely we have that same theme that we are buying domestic stuff and we are buying, in the investment theme. But to some extent, we are looking at some of these sectors which have done quite badly over the last 12-18 months and nibbling into them. So banks is one sector we have been nibbling into. The other sector we are watching quite closely, the chemical sector, which, has done badly. We still think it's not time to buy, but probably, 4 months, 5 months down the road, that's one sector we'll be entering. And pharmaceuticals being one thing which, for quite some time we have been adding to our portfolio, and we are like quite overweight pharma now.
Okay, so you are liking pharma among other things. By the way, just pulling up some stocks and we can fire these up because the broader market is on a tear. There's a 1,000-point rally on the mid-cap index right now. Ashok Leyland, Memphis, Piramal Enterprises, Vesuvius, which came out with numbers. Let's just get all these stocks up because the market is very vibrant. Balaji Amines, Ixigo, the recent listing, Late Travenues Technology. These are stocks up 7, 8, 9, 10%. It's a big move out there in mid caps. Jyoti, so you mentioned I think financials briefly. Now it's interesting. Rarely is it that banks underperform the overall market for such a long time. And now, even the earnings, they're not exactly setting the street on fire. What are you doing here? Are you being patient and are you using all the dips to buy? Or would you rather focus elsewhere? I mean, some of the sectors that you mentioned.
Yeah, so we, like we have this whole philosophy, we buy when nobody likes a sector and we are very patient and we hold on. So we started nibbling banks because, there are two issues with the banks. One is, the NIMs are falling, which is generally like part of a normal cycle, which we expected. The second is the regulatory changes have been hitting a lot of the banks, like even what we got last night from RBI was not exactly positive for banks. So keeping that in mind, we think it's like a bit of long haul, but at the moment, it's the one sector where valuations are not looking out of whack. Like if you look at valuations today versus, let's say, a 5-year, 10-year average, for most sectors, valuations are above the 5-10-year average. Banks, they are reasonably okay. So to that extent, the reason you're getting it is there is some fundamental issue short term in the banks. So for us, it is if we buy today, we are getting something where valuations are reasonable. Hopefully 12, 18 months down the road, the cycle will change again. NIMs will come back, they'll stabilize. And that's where we'll start making money out of it.
Jyoti, short conversation today, but we'll have to let it go at this. Thank you very much for joining in. So bullish on domestic, infrastructure plays, banks, and he's gone majorly overweight on pharmaceutical too. That's the advice coming in from Valentis Advisors. We leave the markets with all the gains intact. It's a 250-point gain on the Nifty. The Nifty is at 24,650. And the change that's happened in the last 1 hour is that banks have gotten back into the green, erasing some of the early losses. It's a wrap on trading hour. Stay tuned. Halftime report is up next.